Joining us on set today, Samana is Senior Global Market Strategist for Wells Fargo Investment Institute. It's great to have you back. Good to see you.
Absolutely. Thanks,
So,
Carl.
no chance you can close out the quarter on at least a stabilizing note, you think?
There should be some rebalancing flows that, will probably come in tomorrow. Those could maybe put in a little bit of a local low. But again, the thing is, we are going to have a recession probably by the end of the year, right? If you look at what the GDP data this morning showed, the consumer's already slowing. And that's before oil prices, started to do what they've been doing recently.
So you're not looking for seasonality or year-end chase or any kind of surprise resolution to the shutdown or a strike giving Q4 a boost?
Yeah, look, you could have some of those things mitigate, some of the economic weakness, but the tricky part is look at what rates are doing, right? Just today, the 30-year was well north of 480. So the tricky part for investors is what do I get paid in stocks to take that additional risk? And if you can get 5% or close to it on the fixed income side, it's just very difficult to say, I want to take the equity risk.
Are you in the camp that corporate profits have troughed?
Probably on a year-over-year basis, the comparisons are very easy in Q4. So you probably do start to see some of those growth rates start to tick positive. But I think it has more to do with a really tough Q4 last year than a really good Q4 this year.
When we were just coming off the October lows.
That's exactly it.
You were talking about rebalancing for tomorrow, and that's just because it's the end of the month, the end of the quarter.
That's exactly it.
Okay. What should we expect for volatility going into the end of the year when we still have so many unknowns? Carl brought some of them up, of course, but strike and shutdown, student loan repayments coming up. You've got the Christmas holiday. How do you factor in all of that when you're looking at the landscape for equities?
Honestly, I'm surprised that we were below 13 just a few weeks ago. Again, I think it would be fair to say that the market was kind of whistling past the graveyard. And from here, I think the skew is probably still to the upside. Now, 18, 20, I think that is closer to the historical average, but I would say if there's a risk, it's to the upside.
Is your view so dire that economic activity can really roll here, and yet the long end stays elevated?
So because of stagflation, right, because of what oil prices are doing, again, it's not so much that this time is different, but I think you have to at least account for the fact that there's a stagflationary element that you haven't seen, probably since before the financial crisis. And honestly, you really have to go back to the 70s and 80s.
You think this is a repeat of the 70s and 80s? Others argue that was about energy to a large degree and a different mix of geopolitics, certainly a larger percentage of the workforce unionized, COLAs, all of that kind of thing created a flywheel in the 70s that would be hard to replicate today.
When you think about the strikes, when you think about oil, it's probably all the headlines that we're talking about today, right? So, maybe it's not a repeat, but it sure is a rhyme.
So what's your allocation? What percentage of a portfolio now is stocks versus fixed income?
So we're a little bit tactically underweight equities. We think there's better opportunities in commodities. We think we're in a commodity bull super cycle because of really good supplier discipline. We also like fixed income. Again, when you can get that kind of 5.5% on the short end and on the long end, we think that fixed income makes a lot of sense for investors. And then within equities, we like large caps. So, I don't want to come across as, overly negative. Our target for next year is 4,700. So we still think the S&P on this pullback is viable. But we really think that the risk reward starts to flip to more favorable, closer probably to that 41, 4,200 area.
Do you think would-be investors are sitting with cash on the sidelines, kind of watching some of the fixed income areas or even money markets and saying, gosh, this is so much of a lower risk than to play into equities with all of these unknowns that we're talking about?
Well, that's exactly it, right? So if you look at earlier this year and you think about, we were around 4,200, and when you kind of tack on 5%, that's about 4,400, which is actually, we're below that right now. So if you had been in cash and you had been clipping that 5% coupon, you're probably kind of neck and neck with what equities have done, and you've taken a lot more volatility to earn the same return.